The Financial Facts of Life, Part 2. Materials provided by Genesis Financial Management. Auto loans and leases. Setting up a car deal requires a lot of knowledge. You need to know and understand the terms. It's one of the largest purchases you will ever make. You may buy or lease every 4 to 5 years. Everyone wants to make money off of you. The car dealership wants to sell you a car. The bank, credit union, or finance company wants to finance a loan. The dealership's finance office wants to help arrange the financing because they get fees and commission from the sale, warranties, and credit insurance. 7 financial decisions you face before buying. How much can you afford or are you willing to spend to purchase a vehicle? How much can you afford or are you willing to spend to operate a vehicle? Can you afford a down payment? If so, how much? Will you buy or lease? Will you pay cash or finance your purchase? If you finance, which terms will work best for you? If you lease, which terms will work best for you? Can you afford to operate a vehicle? Consider the cost of gas. It's the number of miles per year you drive divided by the miles per gallon, multiplied by the cost per gallon. Cost of insurance. This can vary with your age, make, driving record, sex, locale, amount of liability coverage, and your deductible. Cost of maintenance. Things like oil, tires, mechanical repairs, batteries. Taxes and registration fees, parking fees, toll fees. How much can you afford? Lenders use various formulas to determine if you qualify for a car loan. One formula says that 20% of your income gross can be used on debt payments, not counting your house payment. An example would be if your income was $3,000 per month multiplied by 20%, that would equal $600. If you took $600 and subtracted it from your current bill obligations of $300, that would mean that $300 is available for your car payment. Another formula takes into account all of your debt divided by your income. This should not be over 40%. So your income is $3,000, your current monthly debts is $300. So $3,000 multiplied by 40% equals $1,200 subtracted by your house payment, which means that there's still $300 left for the car payment. What about a down payment? 2 people can purchase the same exact car but pay vastly different amounts because of the down payment. The larger the down payment, the smaller your monthly payment and the less you'll pay in interest over the life of the loan. There are 2 forms of down payment: cash from your savings account or the trade-in amount for your present vehicle. You, not the lender or salesperson, should decide on what you can comfortably afford given your income obligations, personal circumstances, and the amount you can afford for a down payment. Make your financing plans before you shop. Check out all the details before you sign the purchase agreement. How much are you willing to spend? How much down payment do you have available? How do you intend to pay for it? Buy or lease. Buying a new car. In buying a new car, you will have its full useful life. Have a factory warranty. Car with the latest equipment and styling. High initial cost. Car declines rapidly in value, depreciates within the first few years. Higher insurance rate on a new car. You will pay the price of the car. You pay interest if you finance the car. Once paid off, the car is yours to do with as you please. Leasing a car. You pay for the amount the car depreciates while you have it, plus interest charges. Leasing. Some terms you should know. Acquisition fee, capitalized cost, closed-end versus open-end leases, disposal or disposition fee, purchase fee, purchase option fee, residual value, subvented lease, gap insurance. Pay cash or finance. If the interest rate on the loan is higher than the interest you earn on your savings, you should pay cash. If the interest is lower on the loan than on your savings, you're better off financing the car. The same applies for the down payment. Financing. Which terms work best for you? It depends on your personal circumstances. When it comes to buying a car, there are 4 essential terms that you need to keep in mind: the cost of the car, the down payment, the interest rate, and the length of the loan. The interest rate varies with the length of time. Typically, higher interest rates for longer-term loans. Some lenders offer lower interest rates for automatic withdrawals from your account for payments. A few more items. Balloon payment. Instead of making equal payments over the 3 to 4 or 5 year period, you can pay lower monthly payments for 1 year, then have one final large payment. Prepayment penalty. Some loans have extra fees you have to pay if you pay the loan off early. Trade-in value. It's the present value of the car minus what you owe. The dealer may subtract a certain percentage from that amount to determine the trade-in value he will give you. The percentage he subtracts allows for profit to him when he resells the vehicle. Know the value of the car before you negotiate. Refinancing your car loan. If you have equity in your vehicle, you could refinance the loan to pull out equity from some other purchase, gain better terms, and lower your payment. Keep in mind, in most cases, refinancing your loan will cost you more money over the life of the loan. Shop a little, negotiate a little. Research prices before you go shopping. Negotiate on the price of the vehicle. Shop for the car, not the monthly payment. Let's make a deal. Shop for financing before going to the dealer. Find the car that you want. Check on the cost of insurance. Negotiate the deal. Compare the dealer's financing with what you find elsewhere. Choose the best terms for you. Read the contract and ask questions about anything you don't understand. Sign the papers. Drive home in your new car. Car loan review. Before you shop for your vehicle, calculate the cost to operate the vehicle you want. Determine how much you will pay for it each month, including interest. Shop for your vehicle as an informed consumer. The 3 most important loans you will ever apply for concerning your home. Your first mortgage. Refinancing your mortgage. A home equity or home improvement loan. It's not just a purchase, but also an investment. It has definite tax advantages, and buying a home is often an extremely emotional experience. Preparing emotionally for purchase. There is no single house that you just have to have. The property and terms have to be right for you at the particular time. You may buy and sell half a dozen houses in your lifetime. Each transaction will be different. There will be at least 10 different people who will be involved in your purchase. Know who all the players are. Know what is expected and required of each player. The buyers and sellers. Buyers. They're the people who wish to buy the home. They should have an idea of what is important, 2 bedrooms or 3. They should have an idea of the price range they can afford. Sellers. They are the people who are selling the home. A seller will have a sales price for the home. They may be willing to negotiate on the price, terms, or property included in the sale. The lender and mortgage loan officers. The lender is the bank, credit union, or mortgage company that lends money for the home. The loan officer is the person who arranges the financing and assembles the documents needed. The mortgage loan officer will evaluate your situation and discuss the loan products that you're eligible for. The mortgage loan officer usually charges fees for his or her services. You should know how much you're expected to pay. What the loan officer will ask you: about your job, how much you earn, what kind of bills you have, how much you owe, whether you pay your bills on time, about other personal financial information. Information shared with the loan officer is confidential and will not be shared with any other parties without the borrower's permission. Real estate agents. The buyer's agent shows the house to the buyer, helps prepare the purchase agreement, presents the offer to the seller's agent or seller, can be paid by the seller from the proceeds or by the buyer. Seller's agent. Lists the house and advertises the property, represents the seller in the transaction, presents the purchase agreement to the seller, paid by the seller from the proceeds of the sale. Real estate agent. This agency is the working relationship that a real estate agent has in a transaction. In other words, who does the agent represent? The buyer's agent represents the buyer. The seller's agent represents the seller. Dual agency. This is when a buyer's agent is showing the home listed by his real estate company. In this instance, he represents both the buyer and the seller. Home inspector. A home inspector is a person who will do an inspection on the home to determine the condition and possible problems. If the problems are identified, you may be able to negotiate the repairs with the seller. The buyer usually pays for the inspection fee. Your offer to purchase a home should be made contingent on an acceptable home inspection. If problems are identified, the seller is given the choice of fixing them or letting the buyer out of the contract. Home appraiser. The lender will require an appraisal of the property to set a reasonable value. Appraiser is required to be licensed, experienced, and approved by the lender giving the loan. The appraisal is based on comparing your prospective home with other similar homes that have sold within the area the last 6 months. The appraisal is in no way a guarantee of the condition of the home. The buyer usually pays for the cost of the appraisal as part of his or her closing costs. Mortgage insurance agent. Lenders require an insurance policy anytime the buyer puts less than 20% down of the purchase of the home. The policy is called private mortgage insurance, or PMI. The policy will protect the lender against a buyer defaulting on the payments. The insurance is charged to the buyer. It can be financed into the loan. It can be paid monthly. Part of it can be financed in and the rest paid on a monthly payment. All of it can be paid upfront in cash. The insurance usually may be dropped once the buyer has at least 20% equity into the home. Settlement agent. This is a person who takes care of all the paperwork and details of the closing of the deal. Settlement agent could be a banker, attorney, or title company closing agent. The fee for the settlement agent is included in the closing costs for the loan. The title insurance company. Title insurance guarantees that the seller is selling property that he actually owns and there is no problems with the title or ownership to the property. The title insurance also ensures the lender that there are no judgments, liens, or attachments against the buyer that might attach to the house ahead of the mortgage. Real estate attorney. If you're using a real estate agent, you may or may not need an attorney to review your contract. If you're buying from a seller without a real estate agent, you should have an attorney review your contract. If you use an attorney, make sure that they are familiar with real estate law. The attorney is the only person entirely on your side. Common closing costs. Origination fee, discount points, credit report fee, appraisal, title insurance, recording fee, underwriting fee, commitment fee, settlement or closing fee, state transfer tax, survey, odds days interest, homeowner's insurance, property taxes. When you leave the lender, you should know 4 things. How much the lender is willing to lend you based on the information you provided, how much of a down payment you will need to have, the maximum price of a home you can afford, and how much money you will need for your closing costs. The process. See a mortgage lender for pre-qualification. If you have no issues that need to be resolved, apply for pre-approval. Once you receive your pre-approval, contact a realtor and start looking at homes. When you find the home you want, write up a purchase agreement. Notify the lender of your accepted offer and provide them with a copy of the purchase agreement. Once all of the documentation is in and the appraisal has been done, the closing can be scheduled. Request to see copies of the closing documents a couple of days before the closing. Review the closing documents and make sure that you understand them. Go to your closing and sign the papers. You will write out a check to the closing agent for the closing costs you owe. You will receive the keys to your new home. Refinancing. Advantages and disadvantages. Advantages. You may be able to reduce the interest rate and lower your monthly payment. You may be able to take out some of your home's equity for some other purchases. You may be able to reduce the length of your loan. Disadvantages. Refinancing your loan costs money. You have to pay closing costs similar to when you purchased the house. You are basically rebuying your house. If you refinance for another 15 to 30 years, you are stretching your loan out for a longer period than you originally had. Calculate if refinancing makes financial sense. Compare the present monthly mortgage payment with the new monthly payment. The difference between the two is your potential monthly savings. Divide the cost of the monthly savings into the cost of refinancing. That result is a number of months it will take you to recoup your cost. Home equity loans. Home equity loans are similar to refinancing a mortgage. Equity is the difference between what the house is currently worth and how much you owe. So the current value of the house is $175,000 and you owe $80,000, which means that there's $95,000 in equity. Lendable equity is the percentage of equity a lender is willing to loan to you. Home equity loans are the second mortgage against your property. Therefore, you will have a second payment to make. The interest rate is usually higher than on the first mortgage. The term of the home equity loan is usually not over 20 years and is based on the loan amount. You are pledging your property as collateral for the loan. Equity loans can have fixed or variable rates. Equity loans can be used for paying for college, repairs on the house, paying off other bills, vacations, etc. Home equity loans are not something to commit to lightly. If you are in default on the loan, you can lose your house. Summary of Part 2. In this session, we learned about auto loans, leases, the cost of owning a car, home mortgage, the process, refinancing, agents that are involved in the process, and home equity lines of credit. There will be one more part to this 3-part educational program, so stay tuned. Questions, comments, experiences? To speak with one of our certified personal finance counselors, you can call us at 877-202-9246, or you can visit us at www.yourgfm.org. Thank you so much for viewing this video.